Good day, everyone. Welcome to the Daily Ward. And the word of the day is yield, as in yield curve. Now, this isn't going to be a full economics lesson like yesterday's message, but it's going to be informative nonetheless. And here are the things that you really need to know, because you're probably hearing the yield curve inversion on the news a lot. If you don't know what that is, I'm going to briefly explain it. Basically, the 10-year government bond yield, which is the rate at which, the realized rate which investors get on the coupon, the yield is lower than the 2-year rate right now. A few months ago, it was inverted when the 3 and 10, some investors used the 3 and 10 yield, some investors used the 2 and 10. So it's a pretty big deal when the short-term bonds are yielding better than the 10-year bond. So why is that important? It's important because investors are more confident in the short-term return on their money that they get from the U.S. government in this case than a long-term in 10 years. So in an inversion, if this is 2 years over here and this is 10, and I think it's the other way on the camera, the yield curve is supposed to go up, meaning if you're holding your money for a longer period of time, it's more risky, so you would naturally get more yield out of the bond. The government would pay you more because you're holding your money over 10 years as opposed to 2 years, right? So when it's inverted, the 2-year was higher than the 10-year. So the curve, the yield curve going across time of maturities and bonds, there's, all sorts of government notes, bills, and bonds, right? So it's a 10-year T note, I believe. The bills or short term, the medium terms or notes, and the long term, which is like the 30-year, is a bond. So the 10-year is lower than the 2-year. The curve goes down across 2, 3, 5, and then 10, right? That's inverted. The natural shape is supposed to be up. I don't have a graphic to show. I probably should start doing that on this show a little bit. But what I do have is at least the knowledge to explain it to you like that. So what it means for the average and everyday person. First of all, an inverted yield curve is not a measure of or an indicator that a recession is on the horizon. It just so happens that most of the time when a recession occurs, I think it's the last 7 recessions we have had in the U.S. economy, there's been an inverted yield curve for more than a day, right? And I believe it was 2 days last week, Friday and Monday, that the yield curve was inverted. So it spanned the gap of a weekend, and it dipped down. So now, as of today, I think the closing bell of today, the 2-year note was yielding at 155%, and the 10-year note was yielding at 156. Now, the bond market, it can be 24 hours a day because there's liquidity providers that provide bonds to buyers and sellers, but that's besides the point. So it's back to what would be a flat curve now because it's basically relatively flat. And when it was inverted, it was very little, a few basis points. So naturally, if let's just say, for example, if we wanted to have a normal yield curve, the 2-year would be, if it was 1.55, the 10-year should be 2.55, for example. Okay, so now that I beat that dead horse and I've explained it enough to make people understand what it is, why is it not necessarily a measure of or an indicator of a recession? It's not because smart money, the market, investors, what traders like to say, what retail traders like to say is smart money, banks, institutions, foreign countries buy government bonds. When there's some sort of uncertainty over a long-term horizon, they want to lock in a 2-year, for this example, return on an investment if they're buying government bonds. They don't want to do 10 years because they think there's some risk, uncertain risk, to hold their money for 10 years. Now, where we're at in the economy right now, it's in a relatively good point in the economy. So now we've been on a 11-year bull run, and people are getting weary. I think mostly that the reason there's a yield curve is because not only is we're holding risk into what central banks are going to do for 10 years, but central banks across the globe, central banking theory, it's a theory now, just like economics is a theory. Central banking theory modern monetary policy, not modern monetary theory, that's different. Monetary policy in Europe, in Japan, in other places and countries around the world, those central banks have gone negative. Europe has been in a lost decade. Japan has been in a lost 2 decades. But it's just known fact that there are negative yield curves. Now, the Swiss National Bank has negative rates, and it's specifically for a reason, so money flows into their country and people keep their wealth, not necessarily into the bank's hands. But that's a whole, you can really start digging into the weeds of this topic when you're talking about other central banks. What the Trump administration wants to do is they want to produce more easing into the market, so banks they lend off of the overnight rate to each other. Borrowers have easier access to lower rates. People are spending money. Credit is created in the banking system by doing this, and that's how money supply is influenced in the banking system. Just a real quick note on that. But what the administration wants is they want a full point drop in yield. Now, this is dangerous. It's getting into dangerous territory, and this is why there's all this talk about recession and an inverted yield curve. Basically, we're already at 2%. We were at 2.25, 2.5 was the target rate. Now it's a target that the central bank, the Federal Reserve, targets as an interest rate. Now they drove their targets down. I don't believe it was the right call. The Federal Reserve Chairman Jerome Powell is getting political pressure to move the yield or the rates down, the overnight interest rates, the federal funds futures or the federal funds rate, down to, which is a target, a full point. Now, 25 basis points hasn't had a negative effect on the market. The central banks in a country have an effect on the market. It's more widely volatile on central banking news than it is fiscal news. This is the problem. When we're taking more of the Federal Reserve's ability to act if an actual recession were to occur off of the market just to stimulate the economy when it's already pretty much overstimulated, but we still have room to grow. I mean, borrowing rates are the lowest they've been for this long of a period of time than ever before in the history of modern monetary policy. So it's interesting to see that the Trump administration wants to further sequester the interest rates to heighten the flow of money in through the banking system and out into the economy. So I know this is getting super nerdy and detailed, but this is dangerous territory we're floating into, because if Jerome Powell, now they've said that they're worried about weakening global climate, right? Global economic climate being weaker than expected and getting weaker as we go into the future. This is an issue now because the central bank is losing its ability to stimulate the market when it's responding to geopolitical measures. And that's why you're getting all this talk about recession. That's why you're hearing, Trump defend the economy, which is doing very well. I didn't think we need to go back another 25 basis points. Inflation's been moderate through the last few years. Unemployment is at record lows. Job numbers, people were producing jobs. People aren't just getting jobs and holding them. The economy is creating jobs. So I'm interested to see what these punishment tariffs that are now delayed till December are going to have, the effect it's going to have on the market when the September job numbers come out in, I believe it's the 5th of September, the first Friday. So that's non-farm payrolls. But the point I'm trying to make here is this may be overhyped, meaning that the media is overhyping this situation now. I don't think that the Federal Reserve is going to lower rates anymore. They might be under pressure from the Trump administration. They're supposed to act independently. We don't necessarily need to see more stimulation in the American economy, because if we run out of stimulation and we get back down to zero interest rates, we're going to have to do quantitative easing. And you've seen in Europe, basically, and I'm going on too long now, that the quantitative easing measures haven't necessarily worked. And now they're doing this TLTRO, which is another easing tool that they have. So we don't want to get into negative, or we definitely don't want to get into negative, because it's going to cost you money to keep your money in your checking account at your bank. But we don't want to be at zero either. We want to be at a healthy medium. We want inflation in the economy at a nice clip so that pricing isn't necessarily affecting the consumer of the economy, but profits are being driven by pricing going up based on a normal measure of inflation. Now, the Fed has a mandate of 2%. We've been moderate. When I say we have moderate inflation, we've been moderate in inflation. So I think we were fine where we were. What needs to happen is a trade agreement between the U.S. and China, and then you're going to see the market basically explode probably for another 4 more years. And that's a card that Trump is holding. He's holding that card until probably some point next year, maybe later this year, to really drive the market to new highs and create more wealth in the economy. And that's what's going to get him elected in 2020. So he's holding this card for now. Expect an agreement to happen maybe late fourth quarter 2019, and then 2020 the market's going to go up tremendously, and it's going to be a great year for investors. Now, don't mark my words on this, but that's how I see this whole thing playing out. The card is being held. China's trying to negotiate. Trump's not buying on anything, and he's going to lay out his hand later this year, and there'll be a stimulation in the economy, and we'll all be rich, more rich, because if you're living in the United States, regardless of whether you realize it or not, we are, in fact, pretty wealthy compared to the rest of the world. So that's all I said. That's all I got to say. I got a little deep today. I got a little long because this is a topic that I know a lot about, and then also trying to explain this in a way that everyday people can understand isn't the easiest. A lot of people are scared of financial and economic talk because they don't necessarily understand the language. So I hope I could do that for you. I'm going to be doing it every day. I'm not going to quit. This is what I'm doing now for fun. This is the show, The Daily Ward, and I appreciate you for tuning in. And I'll see you tomorrow.